Hello, ladies and gentlemen, my fellow learning partners, my dear students. This video, as you would have seen in the title, is going to particularly focus on a very essential, very critical area for, especially for ACCA students who are taking the Advanced Performance Management or P5 paper, value-based management. This is something that the ACCA examiner has been focusing a lot on lately. If you look at recent past papers, value-based management has been frequently coming up. So it's very important that as students, because there are so many aspects to it, with a clear understanding of exactly what value-based management is, it's very easy to deal with it. And it's not the most complicated idea either. So from what I felt by especially marking answers, I felt that having a very clear-cut understanding of what VBM specifically is can definitely help you, especially if you're taking the paper. But then again, if you're a general audience member who would like to learn what exactly value-based management is, what that approach is, because it's very important to managing organizations as well, I hope this would enlighten you on that front. So let's take a look. Value-based management, when it comes to modern day organizations, these are evaluated based on their ability to generate value in many forms, but leading to one value objective. So this whole concept of achieving objectives, essentially what we call corporate objectives, is what companies are formed on. That's the basis of corporations. And in modern times, the definition of the objective has been updated to show a more higher tendency towards the value creation process. So there are so many forms of value for customers, value for employees, value for the society, and most importantly, value for shareholders, right? Who are shareholders? In very simple terms, shareholders are owners of the business. So value for owners, value for shareholders of the business is something that is being looked at. And this new term that has been added to creating value, because traditionally it was shareholder profits or shareholder wealth maximization. But nowadays, when we really talk about value, there is this association to this additional term called continuously for the long term. So it's not purely just creating value for shareholders in the short run, but it's creating long-term continuous value for shareholders. This is what modern day organizations, modern day shareholders are rigorously looking at. So VBM is basically management to generate value mainly for shareholders while also other stakeholders. And what exactly is VBM? A value-based management approach aligns the strategic, operational and management processes to focus management decision making on what activities create wealth for shareholders. So in a very simplistic approach, what you're trying to do is you're trying to figure out what the activities are that you conduct within the organization, and do those create value for shareholders and other stakeholders, and what are the most value creating, what are those activities that create the most amount of value, and you focus on them and you try to optimize them, you try to improve them, and you try and create more and more value. This is simply what VBM, value-based management, is. Ultimately, you're trying to maximize that. So on that note, let's take a look at the idea of measurement and maximizing, because even when it comes to performance, we always see this term performance measurement and then performance management. The same thing applies to value also. Value measurement and value maximization, value management is are phrases that we continuously see within that scope. So how do you measure shareholder value? Because fundamentally what gets measured gets done, and before you implement, before you improve, before you manage, you need to measure. How do we exactly measure shareholder value? Traditionally, financial measures like EPS and ROCE were used to quantify shareholder value, but it has been identified in recent times. You must be very familiar if you have looked at chapters like chapter 8, chapter 9, performance measurement, divisional performance measurement, that these kind of financial metrics, especially accountants' financial metrics, don't directly relate to shareholder value. VBM begins from the view that the value of a company is measured by its discounted cash flows. So value is only created when companies generate returns which beat their cost of capital. Right? Is that clear? It's again a very simple idea. Rather than looking at what you see on the income statement, what you see on your profit lines on that piece of paper that financial statements indicate to us, we really try and understand what today's value of your cash flows, your future potential cash flows are. Right? This is a slight deviation from the accruals basis, where we don't consider anything that is either immaterial, anything that is not likely to materialize, anything that is contingent, anything that has an element of uncertainty associated. We don't try to look at it as value because we never know what can happen. For example, a good example is COVID-19, right? So many people had so many expectations of generating so many line items, so much of revenue, especially in terms of top line growth, but none of that materialized. So unless you really see something, you don't consider it when it comes to creating and measuring and identifying it as a value component. So what do? VBM focuses the management of the company on those areas which create value. What are these areas? These are called value drivers. So it's like this. The entire VBM process can be broken into 2 steps, right? I think this will make things much clearer. First step in VBM is you try and identify these drivers of value. We call them value drivers. So the first step is identifying them. What are our value drivers with respect to this company that we are analyzing, or with respect to the company that we are working on, or with respect to my company? What are the value drivers? And then you concentrate your efforts on all the levels, strategic, tactical, operational levels, on those drivers that you've identified in order to increase the value of the firm. Now, the idea of value drivers is something very simple. What drives value? I can relate to ABC, activity-based costing, where we identify something called cost drivers. So what drives cost? So a simple example is, if you look at a cost like transport cost, the cost driver is said to be, one driver could be miles traveled. So the more kilometers or the more distance you travel, higher the cost, which is why the distance traveled is the cost driver for the transport cost. Similarly, what exactly drives value? Now, on a very standard basis, the syllabus identifies 7 key strategic value drivers, but by no means are value drivers limited to these 7. Please, you have to have a very thorough understanding of that. Don't limit yourself imagining that these 7 are the only, or are the final set in stone value drivers in the world. They're not. But the 7 key strategic value drivers, on a very general sense, that you can apply in almost all circumstances to almost all businesses, are: number 1, revenue. So if you increase revenue, if you focus on increasing your top line performance, your value increases. Operating margin. So basically efficiencies. If you create operational efficiencies within your company, you can absorb a better margin, and that will ultimately create value. Cash tax rate. So the lower the tax rate, or lower the net tax effect on your numbers, greater the value that is created. Which is why we even if you look at funding of a company, right, debt versus equity, some companies prefer debt because debt is something that is a component that is free of tax. You get a tax benefit on interest, and which is something that directly applies to this, because that ultimately generates better net margins and therefore improves the EPS, and therefore your shareholder value is improved. Incremental capital expenditure. Exactly. In terms of NPV projects, you might associate yourself with this because you're looking at investments and you're trying to maximize the return from those investments, and those investments are essentially incremental capex, capital expenditure. So the better you utilize your investments on capital expenditure, the better the returns are on them, more value can be extracted. Investments in working capital. So your daily operations, how do you manage them? What kind of optimizations, what kind of efficiencies do you improve or include in them? All of that can feed into value. The sixth one is obviously cost of capital. You know the weighted average cost of capital. It's this combination of cost of equity and cost of debt, and we try and always go for the optimal weighted average cost of capital because we want to try and keep the cost of capital low. So even if you go to a bank loan, if you have 3 banks, and among the 3 banks you are most likely to choose the bank with the lowest interest rate, because that means your cost of capital is lower, and that can create massive value. And finally, the growth period, which is something that you might have, even if you are a FM student, you might have learned the word terminal growth rate, right? This is something that we include even in NPV analysis. The idea that, now take for example a product life cycle, right? So what the Apple iPhone, what Apple tries to do is they want to put a product to market, and they do it, and then they try to prolong that life, right? Prolong that life. And by prolonging, what they want is the product to stay in the market for as long as possible, which means the customer continues to buy, continues to associate with that product, and that creates more and more opportunity to generate revenue and optimize the returns through that product. So the same thing applies to companies. If we are on a growth trajectory, we want to keep it as growing as possible. So if you have 100 customers, the growth, you don't want it to stop at 1,000 customers. You want to try and go for 1,000, 2,000, 3,000, 4,000, 5,000. You want to somehow prolong that growth. And that is what growth period is. Longer your growth period, better your growth rates, more value is created. So those are the 7 key strategic value drivers. But again, let me remind you, they're not limited to these 7. And each level of management will be able to link its activities to one or more of these value drivers. Ideally, the entire performance management system of the company will really not just limit itself to identifying these 7, but will also go beyond that and look at other value drivers and see how can we create, or what are the activities that we conduct. As I mentioned in the first slide, what are the activities that we conduct as an organization that are directly linked to these value drivers, and therefore how can I manage those activities in a better way to extract better value from these value drivers. For example, let's take revenue. If you take revenue, one of the key activities that we associate in terms of revenue is maybe, let's say, marketing, right? Your an activity related to enhancing your brand image, enhancing your reputation, and the better your reputation, you can attract more customers. So the activity of marketing is something that is directly linked to the value driver of revenue. And if your marketing arm, if your activity of marketing is very efficient, if it's something that is very creative, that is very unique, if it's something that really works, if it can attract people, then what happens is it does attract customers, and therefore they buy more, which means you're making more money, which means your revenue is going up. As your revenue is going up, since we've identified it as a value driver, I have created more and more value. And when revenue is going up, my margins are up. When my margins are up, my profits are up. When my profits are up, I could either, the perception of the company is good, therefore share price is basically going to go up, because when I'm announcing my earnings to the world, I'm announcing a positive image. So that's on the one end, shareholders are gaining capital gains. On the other end, if my profits are up, it means I can pay more dividends. From that end also, shareholders are making more money. Shareholder value is created. Value-based management. This is pretty much the process. So remember, 2 steps with respect to VBM. As you can see on the top of the slide here, it's the identification of value drivers, and basically then once you identify the value drivers, concentrating your efforts across the board within your entire company to enhance the value you extract from those value drivers. This is what VBM pretty much involves. On that note, we can look at the implementation of VBM itself. There are a few steps. Number one, of course, with strategic performance management, you start by looking at strategy. So you develop a strategy to maximize value. You identify within that strategy what your key value drivers are. You establish performance targets, both short and long term, within the scope of those value drivers you've identified. A plan is developed to achieve those targets. Performance metrics and reward systems are created so that, remember, I told you, concentration of efforts in all levels. So the metrics, the performance measurements, the KPIs, and the rewards, the reward system that you have in place has to be linked to motivate all the staff from all the levels across the board within the entire company. And those are the 5 key steps, and then finally, you just deploy it. You start doing things, right? People start doing things from the operational to strategic to tactical to all levels. These are the 5 key steps of implementing VBM. On that note, what are the key measures used in VBM? Rather, it's this simple idea. Look, what gets measured gets done. No? So if our company is saying that we are a VBM entity, we have value-based management, this is what we employ, this is what we use, then we should know if we are creating value. And how do you know whether you're doing good or whether you're doing bad, whether you're not doing enough? How do you know that? By measuring, which is why the measures used in VBM are important. And these are very common. Number 1 is economic value added. I've heard that this is a little bit of a headache for students, but it's a very simple technique, something that really makes sense. As a management accountant, it makes sense because the changes, the reasons why you are changing those numbers, why you are adjusting those numbers within the formula, I'm not going to go into detail, are because of very logical reasons to really look at value created from the business. So EVA is the primary measure used in a VBM environment. A positive EVA indicates value creation, while a negative one indicates value destruction, right? Economic value added. Number 2 is, of course, market value added. This is just the accumulated EVAs generated by an organization since the day it was formed. So EVA is very periodic. You'll decide that you're calculating the EVA for this year, you're calculating the EVA for last year, etc., etc. There is a frame, a beginning and an end to it, but market value added is the total accumulated EVA, total value created by your company since the day it was started, that entire value. And the third one is this is much more a technique, much more a perception rather than a measure itself, and within which we have so many analysis. And these 3 are the key measures used in VBM. So if you're a P5 student, if you're getting ready for the exams, maybe do a little bit of reading. Just even Googling is sufficient to try and get a hang of it. But don't forget, EVA is important. It's a key part of your chapter number 9, right? Divisional performance measurement. So make sure that you look at ROI, RI, and EVA definitely. But these are the 3 fundamental measures used in a VBM environment. So if a question is more about VBM, more about value-based management, this is definitely worth remembering. On that note, I think we can get to the final part of VBM, which is evaluation. Right? What are the merits and what are the demerits of value-based management? What are the pros? What are the cons? Now, it's a very subjective idea because it's not the most simple approach if you complicate it, right? So, obviously, one of the best things about VBM is it focuses on value as opposed to profit. So, this traditional sense that profit was value is completely, kind of challenged under VBM. Not really challenged, but shareholders' perception of what value meant has changed, right? If you look at a shareholder, what a shareholder wanted in 1950s, 1960s to 1980s to the current day, to the modern day shareholder, the idea of what value meant for them has evolved. So VBM really does focus on the most modern sense of the definition of the term value. It focuses on the long term rather than purely the short term. Another positive is that when you are a VBM entity, you become forward looking, because value itself is about the estimated future cash flows, right? You're trying to look at your company in terms of future economic benefits that you're hoping to derive. And when it's future, you're automatically becoming a very forward looking entity, forward looking organization, forward looking management team, because you're trying to think about what I'm going to do next year, what I'm going to do the year after. Those are the kind of questions that are running in your mind. And on that note, one of the more neutral but traits of VBM is that value measurement is not a very simple and straightforward process. For example, you know that EVA has more than 160 adjustments, right? EVA proposed by Stern Stewart has more than 160 adjustments, because cleaning up the operating profit number, cleaning up the capital employed number, which we take from the financial statements, is a very hectic process, because that number can be subject to so much of manipulation. So I feel like, we are kind of running backwards. We could have kept it simple, but we kind of really bringing in the IFRS's, kind of skewing those numbers, right? Playing around with those numbers, applying our projections, our thoughts into those numbers. We've changed that number, we've warped that number so much that we have to clean it up as management accountants. So that is something that VBM pushes us to do. So it's not the most simple, not the most straightforward process. One of the key challenges with VBM is that it can become an exercise in valuing everything and changing nothing. So you're trying to create value, right? That's the whole point. But what if you focus too much on the measurement and the intelligence part of it, but less in terms of the application of it, right? Like what many students do, and why P5 commands the lowest average pass rate, because students don't apply. So VBM also shouldn't be put into an organizational context in such a way that you forget to use the information that you gain from the VBM exercise. You can't just value everything but do nothing, right? So that risk is there. It really is not a problem with VBM itself, but more a problem of who does that exercise, and to what extent whoever conducts it, the leaders, the management of the company, to what extent do they really understand VBM and understand how to use that information. But this is definitely a general challenge that is as posed to organizations with VBM. And finally, another, not really a negative, but a more general challenge is that your information systems, that to manage a company, information is critical. And what information are we talking about? For us, it's the management information. And how do we extract and systemize and view this information? Through MISs, management information systems. So these systems may need to be adapted to take account of the need to measure non-financial indicators as well, because value essentially doesn't purely relate to finance, doesn't purely relate to short term, doesn't purely relate to internal, but it's also external, it's also non-financial, it's also long term. Because of this, our entire management information system, everything that is within the information system, will have to get updated, and that is not the most easy thing to do when it comes to organizational reform, organizational change. So these are the key traits that either can be a merit or demerit in terms of value-based management. So I hope, on that note, I hope that you have a good understanding of what exactly VBM is, the steps involved, the real understanding what exactly is the objective of a VBM exercise, how do you measure, and necessarily a characterization and an evaluation of the traits within VBM. I hope you gain that understanding. and make sure that you do the technical, you work on the technical know-how related to VBM, and picture it in one image. Don't have clusters in your mind. Picture it in one image. Your EVA technical know-how has to fit into your VBM image in your mind, right? So EVA, MBA, and SBA are all within the larger, broader picture or broader image of implementing VBM within a company. I sincerely hope that you have a better clarity if you didn't before you watched the video. Keep learning, and I know that your exams are coming up soon. Even if not, I hope you learned. All the very best. Do well, and make sure that while you learn, you live life to the fullest and keep smiling. Take care. AZB here, signing out.